Huge signal in the silver markets today. The manipulation we've been discussing is no longer subtle, it's structural. And this week, it showed itself again. It's Ashley Queen, and after Wednesday's halt, silver dropped straight to 87. Not randomly, not because of vibes. It dropped directly into the 87.20 to 89 zone we've been tracking as former resistance turned potential support. That level held at first. Buyers stepped in. Price bounced back toward 90, and then it failed hard. Silver flushed to 85, and now it's hovering around 86. The 150 EMA sits right at 85, acting as a technical magnet. Now understand this clearly. The 150 EMA is not magic, it's not destiny. It's a confluence level where technical traders, algorithms, and discretionary funds often overlap. When price reaches that zone, it becomes a decision area. And when you combine that technical confluence with what's happening under the surface, the story gets much more interesting. Before we go further, let me introduce myself properly. This is Ashley Queen, and on Woman Stacker, we don't react to candles, we study structure. If you want daily breakdowns that connect market plumbing to price action, subscribe so you don't miss our daily market wraps. Because in this environment, the details matter. Now let's zoom out. The headline that dropped alongside this volatility wasn't retail, it was institutional. Jane Street added 20.6 million shares of SLV in Q4, making them the largest holder with roughly a $1.3 billion position. Pause there. When a quantitative firm builds a position that large, they're not hoping for a slow, peaceful trend higher. Size like that creates optionality. Optionality creates influence. Influence creates opportunity to extract edge from volatility. And the edge is not in predicting direction, it's in exploiting reaction. Let's walk through the mechanical loop. Step 1. Accumulate enough shares to matter. Not enough to own silver forever. Enough to move short-term liquidity when needed. Step 2. Wait until positioning leans aggressively one way. When retail traders, momentum funds, and short-term speculators become heavily bullish, put options get cheap. Why? Because perceived downside risk collapses. Step 3. Accumulate puts in size. Step 4. At the right moment, unload a meaningful portion of accumulated shares. Liquidity thins, selling accelerates, price drops sharply, retail panics, stop-loss orders cascade, volatility spikes, and the puts that were purchased cheaply explode in value. Step 5. Close derivatives for large gains. Step 6. Reaccumulate spot lower. Step 7. Squeeze shorts, spark FOMO, push price higher, reset the board, repeat. It's not emotional, it's structural. And you referenced real regulatory context that makes this relevant. In India, regulators accused Jane Street of generating approximately $550 to $567 million in alleged unlawful gains tied to expiry day strategies. They were temporarily barred in July 2025, later conditionally reinstated after compliance, and deposited the alleged amount into escrow while appeals continue. They are also under scrutiny in China following that probe. Why does this matter? Because the toolkit travels. The same volatility extraction logic applies across assets. Now, bring that back to silver. Jane Street is now the largest SLV holder. You think that's passive? Or is it positioning for volatility cycles in a market where retail participation is strong and reactions are fast? Here's the part that matters most. If you react emotionally to every $5 swing, you become liquidity. If you understand structure, you become patient. The macro thesis for precious metals doesn't disappear because of a short-term flush. But you only benefit from long-term structure if you survive short-term volatility. So let's go deeper. Underneath the chart, underneath the candles, underneath the narratives, let's talk plumbing. First, COMEX backing. Silver backing futures has fallen to 86.3 million ounces. That number matters because futures markets rely on confidence. When backing declines, the cushion under paper claims thins. Second, lease rates. Normally, 1-month silver lease rates hover around 0%, sometimes slightly positive, sometimes slightly negative. Anything above 0.5% signals stress. You cited the progression: 2023 average plus 0.04%, 2024 minus 0.18%, today plus 1.6%. That's not a small shift, that's a structural change. When lease rates spike to 1.6%, market participants are paying significantly more than normal to borrow physical silver right now. That suggests urgency. That suggests delivery needs. That suggests tightness in available supply. Now let's move to swap rates. A swap temporarily exchanges silver for cash. Normally, swaps trade slightly above cash rates because silver holders want yield too, but you cited negative 2.8%. That means participants are effectively paying to secure physical silver today while agreeing to return it a year from now. On paper, that looks like free arbitrage. So why isn't everyone doing it? Because the market does not trust physical silver will be easy to source next year. The problem is not money, it's certainty of delivery. And here's where the divergence becomes obvious. When lease rates and swap rates scream scarcity, but spot price consolidates sideways, you're watching physical stress diverge from paper pricing. Now let's connect that to Wednesday's halt. You cited 31,828 contracts traded during the halt. That's roughly 159 million ounces potentially cash settled. During a halt, retail participation is limited. So when volume prints, it suggests settlement mechanics are operating behind the scenes. You also pointed out this was the second major halt in 3 months, both occurring right before first notice day in major contract cycles. February gold contracts still show 4,000 open, roughly 12 tons, around $2 billion, that should have settled but haven't. Shanghai Futures Exchange suspended 25 trading groups in February for position limit violations. When halts, delayed settlements, and enforcement cluster around delivery windows, that's structural stress. Now, look at the geographic divergence. Shanghai spot around 97, Shanghai futures around 100, Western spot around 86. An $11 premium, same metal, different pricing. When that premium persists through volatility and failed breakouts, that suggests structural separation between physical demand and Western paper markets. Here's the key distinction. They are not halting because the price is too high. They are halting because it's moving too fast. Gradual price increases can be absorbed. Velocity triggers delivery pressure faster than contracts can be rolled forward. When speed becomes the problem instead of level, you're watching the system manage the gap between paper claims and physical availability. Now add another layer. COMEX open interest is at historic lows. When open interest collapses while physical premiums persist and lease rates spike, participants are reducing paper exposure. That suggests growing caution about settlement dynamics. Then there's India. You cited that $385 billion in actively managed equity funds are now permitted to allocate up to 35% to silver and gold instruments. Institutional capital has formal permission to rotate into hard assets. That is not a small development. And miners are telling you something too. Silver is down roughly 27% from highs near 120. Mining stocks are down only about 6.5%. When miners outperform the underlying commodity during corrections, it often reflects forward expectations that remain intact. Now let's be honest, there is a delay case. Jane Street can influence short-term volatility cycles. Shanghai premiums could narrow. COMEX can continue rolling contracts. You cited 71 million ounces rolled forward recently, relieving immediate pressure. That's the delay scenario. But the counter pressure remains. Lease rates at 1.6%, swap rates at negative 2.8%, volume during halts, open interest collapsing, miners outperforming. These are not emotional indicators. These are structural indicators. Algos can manipulate CHOP. They cannot manufacture new silver. Exchanges can halt trading. They cannot reset lease rates. They cannot erase swap rate stress. They can shake emotional traders. They cannot shake industrial demand. So what does this mean for you? It means stop reacting to every candle. Start watching the plumbing. Because when paper markets diverge from physical stress for long enough, something eventually resolves. The question is not whether volatility continues, it's who survives it. This is Ashley Queen. You're watching Woman Stacker. If you value breakdowns that connect institutional positioning, market structure, and physical signals, subscribe so you don't miss our daily market wraps. And watch this video right here because it's a perfect fit for you. I'll see you on the other side.